It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. This is Managing Your Financial Future. It is the podcast. It's the one I've been waiting for. We had episode 100, 2 episodes ago. Last week was number 101. We didn't hit the episode 100 with a guest. Professor Rick Plum, first of all, before I bring our guest on, Professor Rick Plum, you're here every week with me.
Hello. Yes, I am.
Certified financial planner, professional, and all that stuff. And it's usually you and me sitting here by our lonesome in the studio. And we don't normally have guests, but when we find somebody so brilliant, somebody so absolutely capable of taking over an entire podcast, him or herself, we have to have them on.
So they couldn't show up and we got Terry?
Well, see, here we go. We're starting with the insults already. I want to introduce you folks, or reintroduce for people who used to watch our television show, Terry Keys, who is a ChFC. Is that correct, Terry Keys? Hello.
That is correct. That is that introduction, by the way, John Dean, was a little underwhelming for me.
Well, you're used to, I know, see, you're used to the fanfare. Remember like the old imperial margarine where the crown appears on the head? Exactly. You want the red carpet. I sent a limo for you, for crying out loud.
All right.
So I don't know what more you want. Terry Keys, your ChFC or CLU?
Chartered Financial Consultant, ChFC.
That's what it is. Okay. Which it qualifies you to do all kinds of things, just like Professor Plum.
When I had a little over 20 years experience in the industry and licenses and degrees and all that, I was excited to tell people 20 and 25. Now what I tell people is more than 30 years experience.
You stopped at 30?
I stopped at there's just more than 30 years experience.
Well, you and I have known each other for over 30 years.
Right.
Well,
it's embarrassing because I went to an industry meeting in Minneapolis 2 weeks ago, and I don't know why they did this, but they said, one of the speakers was coming up. That's what it was. And they said, this gentleman got licensed in 1989. Anybody in the room before 89, and like 3 people, and they said, all right, and they went around the room. There was 3 of us, and I won the award for the whole room of 50 people in the room. 1983 was my first license year.
Ask how many people in that audience were even alive in 1983, or God forbid, 1989. Yeah, do you know there's an intern that works part of our program who was born in 2001. This is a college kid that we have come in, and he was born in 2001. I mean, there are people who were born in the early 90s that are saying, we got young kids working for us. I don't want to keep going back and forth on this age thing.
No, but let's relate it to money for a second. But think about this. You're born in 2001. Interest rates have been low for almost 20 plus years now. These people don't know what regular interest rates are. They think 1.5 is a normal interest rate.
Well, and I talk with a lot of younger advisors, and they don't have the same mindset as somebody who may be getting ready to retire. And maybe I didn't back then either, but now that I'm getting closer, there's a different mindset. So it's not all about return, like you are when you're 20, 30, or you've never seen a bad market for longer than 3 months like we saw in 2020. They haven't realized, they've never seen those down markets. Maybe we're seeing one now.
Well, this is a great segue, and Terry, that's why I have you on, because you know how to do this stuff. I know you've dealt with this, Professor Plum. You've dealt with this with various people that you've talked to, clients, whatever it is. Many of the people that you guys both deal with have seen. Certainly they remember 2008. They probably remember 2000, I would imagine, because that was only 22 years ago. They've lived through a few of these. But at the same time, every time you go through these types of bear markets, whatever it is, it produces a lot of fear. Terry and Professor Plum, talk about this. Terry, you first. So, what are you telling people as far as these down markets go?
So let me set it up first. So there's a difference between a retired client, someone in their 65 to 75 year range that we're dealing with every day, and someone 30 years old that's still going out to work at a high tech company or at some type of an office job every day where they're adding money to their 401k. So I joked about the interest rates, the difference. Remember, people that are retired want high interest rates because they want to earn money market rates. They want to earn 4 or 5% on their cash.
They want to earn high rates on safe
money. Exactly. That's it. In bucket one, right? So, but younger people really want low interest rates because they want to borrow money to buy cars and houses and other things. So there's a dichotomy that exists right there. And secondly, the people that don't even remember any market crashes because they weren't alive is one thing. But what I've been doing, John, and what you're leading to is I've been sitting down with people saying, because the first question I get at every review every week now is, what are your thoughts with this crazy market? We're down 21% on the S&P at one point. We're down 14, 16% on the Dow. And what are your thoughts on that? And so I kind of walk through a little review with people to say, look, we've been here before.
Nothing
we've
new.
had bear markets before. And I'll go through that with you, Rick, in some of the, and I'm going to do it in rough numbers. I don't have data in front of me, exact stuff. You can Google it and look it up yourself if you want. I'm going to give you the general idea of putting it in perspective. So bear markets have happened before, correct, Rick?
Oh, yes.
I'll quiz you, and I know you probably know the answers, but if you don't, I'm not putting you on the spot. Recovering from a bear market. In the history of all the bear markets that have been recorded since about 1920 or 1915, when they've been keeping the records of the market, what was the longest recovery? How many months do you think it took to recover from the worst bear market?
That was probably in the 5-year range.
You're within 1 month. It's 61 months. See, I know you know, John. And it was right after the Great Depression and that stock market. That was the 61-month recovery. It's the longest recovery. And what is the shortest recovery in your mind, Rick?
June of last year, or 2020.
April or May of 2020, 2 years ago.
You're talking about of 2020. It was like a blip. It didn't happen.
It was when the pandemic started, right around March 15th or something.
We're talking about recovering to where it was
the previous high.
Previous high, yeah.
Okay,
pre-drop.
so drop and then come back to where it was previously.
And the average of all the bear markets that we've had is 24 months.
Yes.
Roughly. Yeah. So that's step number one for putting it in perspective. When I'm meeting with a client now and say, it's okay, we've been here before. But what I've been doing, Rick, I think I shared this with you. I actually look up before I meet with them the total value of their accounts 2 years ago today. And still meeting with people today, I haven't yet to meet with a client that isn't somewhat higher today than they were 2 years ago. So as bad as they think things are since the beginning of this year, you still have more money. And when we met 2 years ago, you were very excited about where we were. You were very happy where we were. So that's another way to put it in perspective for people. And I can't really give it to them because I'm looking up old numbers and stuff, and I can't print it and say because it's not current data. You know what I mean? It's 2 years old.
In other words,
just look it up and I show them, look, this is where you were.
So psychologically, in other words, they were happy to be right where their level is right now.
Sure.
Either in their 401k or their total portfolio.
Yep.
And that was a few years, 3 years ago, whatever it was. Now that they've been higher and come back to that, it's like,
but
I don't like it.
People that we've talked to, they don't remember or they don't feel like they were rewarded too much when the markets were going up and up and up. They were just kind of along for the ride. The downturn is where they start freaking out.
That's why you got to have this conversation.
Right. You got to remind them.
Right.
You did really well for a little while. We've had a hiccup. Okay. A big hiccup.
A normal one, by the way.
Yeah, not unrealistic.
So talking about doing really well, there was one heck of a low interest rate run in this country for a long time.
30 years.
There was one heck of a nice sustained bull market for a long time. Rick, I gave you these numbers in your office a couple of days ago or last week, I think. But the last major correction bear market of 2008, it began in the fall of 2008 and bottomed out in the spring of 2009.
March 9th.
March of 2009. And roughly the market was at 10 or 11,000. I'm just using the Dow now. In the fall when this started. And the low was right around 6,600, Rick. Are those numbers roughly? I'm not, again,
it was down 40-ish%. Yeah.
It was 37, 38%, I want to say.
It was a fairly ugly.
Okay. So that recovery did not take a full 2 years. Okay. It was one of the bear markets that was close to the 2 year average.
Now, the previous, though, it didn't start in 2008. It topped out in 2007, went kind of flat, trending slightly lower. And then we had the big decline in 2008.
Right. Now I choose to start it in September of 2008 because that's when EIG announced its illiquidity issues.
And the Lehman Brothers.
Right. But we were starting to trend lower about a year before that.
Sure.
So for people who were investors, it wasn't just from 2008 to 2009 to get from the top to the bottom. It was from 2007 to 2009 to get from the top to the bottom.
But within 24 months, they were back at 11,000-ish in the Dow that was, and their portfolios were back.
What we experienced, what I saw, they were not back to 24. They were out sitting on the sidelines because they thought the market was going to continue to crash, and they got out. They didn't experience the recovery.
And that's
John, the problem.
That is how you segue this whole thing to buckets right there. Rick just did it for us. Because the reason I make the statement the way I make it is my clients were back because
they didn't get out.
They didn't get out. Their bucket 3 remained their bucket 3. It changed. I tell people even right now, the only thing you have to do right now is just don't look at your bucket 3. The rest of your portfolio, all your other buckets 1, 2, alternatives, all those things are doing what they're supposed to be doing. So if it bothers you, just don't look at it.
So don't look at it because you don't need that money for what, 10 years, 15
Everybody's
years?
plan, they're in their different phases of their plan. That's a great question, John. Some people that are just starting a brand new buckets plan last year are a 15-year plus bucket 3. Some people, we don't rebalance the buckets perfectly every single year. There's no need. It's not necessary. So there's people that might have, some of my clients, I have them on about a 7 to 10 year time frame on their bucket 3 right now. So everybody's a little bit different, but it's long term. For me, it's all more than 7 or 8 years.
And is this why you do buckets? Can I ask a leading question like that? Because
that's exactly why
when markets are going straight up, as they kind of did since 2008, through really the end of 2021, when you think about it, when markets are going up, basically straight up, I mean, everybody's winning. What are you playing defense for? The question sometimes comes up, well, gee whiz, why aren't I 100% in the stock market?
I make sure I don't ever leave a review with a client without showing them directly exactly where the money for the next 5 to 7 years is going to come from that I'm sending them. These are the people that are taking monthly income from their portfolio, retirees. And I make sure, now look here, right on paper, in these accounts, the exact accounts, these are where, and look at, these are not related directly to the market in any way, any of these. So that's the reaffirmation before I leave a review meeting that you won't have to touch your bucket 3. Now, people in 2008, 2009, and right up till December of last year was the peak of this last run up. By the way, that's where I was going a minute ago. This last run up started over again in March of 2009, and pretty much with a couple of hiccups in there.
Well, with the one bear market in 2020.
Yeah, which was a short one too.
Quick.
Yeah, again one. It pretty much ran straight up for 10 years, and everyone kind of got used to it. And that's why you have to have these reminder conversations.
Well, and I will say a lot of people got used to being up and up and up, but people that tend to play the market, so to speak, I remember talking, John knows who I'm going to be talking about, in 2011 when the downgrade of the S&P happened, and they were sure the market was going to crash, so they got out of the market in August or whenever, just before the announcement, and it crashed, but it didn't go down 20%. It went down 11, 12%, and then it came roaring back, and he wasn't in. And so he missed out. He didn't get back in until months later when it was 10 or 15% higher than where he got out from.
No one knows the answer to this question, so I'm not going to make any predictions here or anything like that. But I'm going to tell you, my gut tells me this correction, this 20% correction right now, is going to be on the shorter side of the 2-year to 5-year deal than on the longer side, just because of all the factors involved with this particular situation. Your thoughts, Rick?
I think this is going to be a longer.
See, that's why no one knows.
You guys are 50-50. One of you is going to be right.
No one knows.
Well, I mean, the way the economy is going, the way the things are happening, everything that's going on, both domestically and internationally, it just seems like inflation is going to be here for a little while longer. We're going to have a drag on the economy. I have no idea for perfection notices here. I just think this is going to be more of a drawn out one.
I tend to agree with Terry.
What we're hearing from some people that this inflation is transitory is not correct, Rick?
No, I tend to agree, and we're not making any predictions,
No,
folks.
these aren't
This is
predictions.
For the
not-
record,
no.
yeah.
And this is the
This
problem
just
with
a guess.
listening to
But-
people that actually pretend to know the future.
They should they should say what I said a minute ago. No one knows.
No one knows.
Nobody knows.
I see this, of course, inflation's worldwide.
Yep.
I mean, this is not strictly an America problem.
No,
it's
no,
post-COVID.
yeah.
The economy opens up. Everybody comes back up. And nobody can keep up with the demand, okay? That's just the way it is. It could have been easily predicted. To me, I see it more on the shorter side as the supply lines start to ease up. Could be wrong, I don't know. But, of course, the point is that you were making, Terry, and actually both of you, Professor Plum and Terry, is that Who cares? I mean, yeah, you cannot stop your wealth. Buckets will not stop your wealth from declining in a bucket 3 portfolio. Markets are going to do what they're going to do, correct? What you need to be concerned about, at least I think most retirees need to be concerned about, is this going to affect my lifestyle when I'm retired? Is this going to affect my income? Can I still pay my bills? And correct me if I'm wrong, this is why you set up buckets, if I may say it again.
Exactly. You do not want to be in a position where you're pulling money out of a portfolio to meet your living expenses, your fun expenses. Forget living. Let's have some fun. You don't want to be selling things when they're down to be able to create the cash flow that you need to live. And that's what's unfortunately happening for people that were in a typical balanced portfolio or an all-market portfolio. I think an all-market portfolio for somebody who's retired is a little crazy unless you don't need any money. But if you're taking money from a portfolio and selling assets when they're down, you're asking for trouble. That's just the bottom line of it. And so
reverse dollar cost averaging.
Yep.
Yeah, there's a technical term for that. When you start taking money out of a portfolio that's already going down, you're exacerbating that problem. You're turning the spigot on, and it's already got a leak.
Yeah, you're selling a lot of assets for less than they're worth or what they're currently worth.
So recently, and I talked about how older people want higher interest rates and younger people want lower interest rates. The same is true of the market. A dichotomy exists. Well, older people we meet with, they just love to and want to see every year on a full annual review. They want to see that their bucket 3 grew.
Yes.
How'd my bucket 3 do? Mm-hmm. Even though we're not touching it for the next 10 to 15 years, they just enjoy seeing that.
Well, it feels good.
Right. And
younger people want it to go down.
Well, here's what the point I was going to make, though, Rick. The younger people don't know they want it to go down. I know they do.
They should want it to go down so they can buy everything on sale.
I go to a backyard barbecue not 2 weeks ago with a bunch of 40-year-old people.
Youngsters.
Knowing the but they're still got a long way to retirement. Is my point. And they're all complaining about the market. What are we doing? What do you do? I said, well, wait a minute. How old are you? 40, 42? Yeah. And you have a 401k at work? Yeah. You put in a fair amount. You try to put in as much as I can. This was the conversation I had. It says, well, I don't mean to educate you too much here, but you actually should be really, really happy right now, I said, because every paycheck that you're putting money in the market now, you're buying at a 20% discount right now.
From where it was.
So really what you want is, he goes, I do? I go, yeah, you want the market to crash.
You want to buy as many cheap shares as possible before the recovery.
And that's you said a dichotomy. That's exactly what it is. It's psychological. Weren't people thrilled in December of 2021 to be putting as much money in their 401k as it's
at record highs.
Stocks were expensive as heck.
The other response I have all the time for people, because I get this too, is, well, my 401k was $200,000. Now it's $160,000. I go, yeah. And so how old are you again? 42. Okay. And what's the earliest you can touch your 401k? Oh, 59, 60 years old, right? So isn't that retirement money anyways? Okay. Well, then what does it matter? And then you just go right back to the average bear market recovered in 24 months. I mean, it's
you got 20 years, 18, 20 years.
Technically, you haven't lost anything.
Unless
you sold it out, you haven't lost anything. And it's just hard for people to get a grip on that.
Regardless of your age, if you're going to need money for a new roof or a down payment on a house or replace a car, it should not be in the stock market. I don't care how old you are. Buckets of money is nothing more than earmarking your money. The old term earmarking.
Of course.
So we're going to earmark what we need for the first 5 or 6 years and put that in a all money market type equivalent type account. Mm-hmm. Okay, something that has
laddered CDs, laddered individual
stock
bonds.
Market exposure whatsoever.
No, something where you know what the returns.
So you're just earmarking it. Then we can afford to earmark some mid-range money in bucket 2 that you're going to need in 6 or 7 years, and we can put all the rest into alternatives in the stock market.
Now you're talking about somebody who's retired doing that, but somebody who's not retired,
but anybody can do it.
Should have some form of, if you don't want to call it buckets, because they're really not.
Well, they have 2 buckets: an emergency fund and a long-term growth bucket.
Correct.
Right, and sometimes for certain reasons, I've had 40 and 50-year-old clients have a bucket 2
for college education,
motorhome. We're going to purchase a motorhome right before we retire, and we want to start saving money now for it.
Yeah.
So we want to expose that to the market.
Not all your big expenses are the day you retire. You have different expenses, but that's the whole idea. Earmarking, however you want to call it. You're looking at what am I going to need to spend from my portfolio. Realistically, that 40-year-old, they are bucket number 1. Their ability to earn a living is bucket number 1, with the exception of emergency funds. And if they're 40 and they're not going to retire until 60, they're bucket number 2 as well. Yeah. So they're accumulating, trying to fill up bucket number 3 as much as possible. But once that 40-year-old ages into 55, 60, where they're going to be within that 5-10 year window, then they start looking at filling their bucket 2, ultimately filling bucket number 1 before they get to the retirement. Because the last thing you want to do is let the stock market dictate your income, or let your stock market dictate when you want to retire. Because it can't. I mean, it will be an enemy of yours.
Do you see people who are maybe in their 80s and they're not going to live to be 110? So their bucket 3 is really more for perhaps their heirs. They want to leave as much as possible. They don't even need to touch it. Do you see them saying, "No, but you know what? I had $1 million and now it's 800,000, whatever the number is," and they say, "This is really upsetting to me." What do you tell somebody about that?
That's a great question, because and this happens every week as well. And it's been happening a lot lately. Exactly what you said, John. I tell people, most of my clients that are beyond the age of 75 or 80 now and already are 10 years into retirement or whatever's in their bucket 3 now is for most, since this is not, doesn't go for everybody, but for most people, that is their heirs. Let's just call it, in this case, their children's money.
Sure.
So now I'm investing that money. How old are your children? 48, 45. Well, I'm investing that money like a 45-year-old one. The question comes up, "Terry, should we maybe get out of the market a little bit?" I said, "What? You're forgetting the whole reason why we have this 15-year plan." A lot of times, especially with Roths, Rick, I tell people, look, unless something changes drastically or that we're not aware of, this Roth is pretty much your heirs' money. I mean, in
many cases, yes.
Yeah. So, and I invest the Roth like in an 80-year-old's account, like a 40-year-old.
Because that 40-year-old or 50 even, and maybe in their 50s, who knows, even in their mid-50s, this person inheriting it, I mean, maybe they're going to want to spend it. Maybe it's something that they were counting on to get right away. But as you said, I mean, we're not going to invest this like an 85-year-old would. You're going to invest this for, if this is indeed for their heirs, you're going to invest it like they would.
I have some rare situations where the clients of mine are mid-80s now, mid to late 80s, and their children are older 60, than I am. Yeah. Well, so 65 maybe even. Yeah.
Well,
so that's totally possible. An 85-year-old can have a 65-year-old. Yeah. So in that particular situation, there is an exception where that money also is, we're doing less and less bucket 3 for the whole estate, just because when those people pass on, say it's 2 people and they have 5 children, in the instance I'm thinking of, they do. So that money's going to get split between 5 people. So they're not going to have the large sum that the mom and dad have right now.
Yeah, the million turns into 200,000
each. This is a little more than that. But
I know. But there's also, you were talking about the older client now saying, I'm worried about the market. Most of those people that have that money, bucket number 3, that they're not going to use, that are that worried about the market, they were worried about it when it was going up. And so they've already told the advisor, I want to be more conservative. I don't want to see losses. Regardless of whether it's for my heirs or not, I can't handle it. And so that money is usually not invested in the market before the downturn happens. So that's been happening along the way for especially the last several years, when they're like, you know what, this has been a lot better than we expected. Let's just safeten it up. I don't want to see any losses. I know I'm investing for my heirs, but I still own it and I still can't handle it.
So back to the market just for a minute. And again, no one knows, but we've already experienced a pretty healthy correction. So it's going to be really interesting from now till Christmas of this year, 6 more months, just to see where this market takes us the rest of the way. And it's going to see how the supply and demand on oil prices works out between that period of time, too.
Oh, yeah. Oil's a huge part of this.
That's a big part of it. I mean, it's a tax. When gas or oil goes up, it's a tax because it's something you have to do every week.
It's extra expense.
Yeah. And, someone else reminded me the other day, too, is, we always think of gas tax in cents. Some gas taxes are a percentage. And when the price of the oil goes up, the percentage is a larger number of cents. So it doesn't always stay even, too. So it exacerbates the whole problem. But I was telling you guys before we came on the air here that in 2009, the national average of gasoline in the United States was $4.09 today. As of yesterday, I don't think I saw it today, it sat at $4.90.
$4.90 today, but in 2008, okay. The high you're saying of gas prices
was $4.09.
Was $4.09 a gallon.
Yeah, but if you adjust that for inflation, we're right here today where we were in 2009, and everyone's running around like it is the actual highest gas price we've ever had, just because inflation happens over our lifetimes.
The number is.
But in relative terms, we've been here before.
We have been here before.
Yep.
It's shocking to think about this. Every time, maybe because of the amount of time in between, you have 12
That's
years,
exactly what it is.
13 years, and half the young population doesn't even remember this, but you have these things happen, and every single time they happen, it's like, I am surprised. I am shocked that this kind of thing is going on.
I'm not surprised, but I still think it stinks when I go fill up a vehicle.
If you listen to general news shows every day, not the market networks, because the markets the market networks do a good job. But in general, I'm not going to name the morning show, but the big one, okay, that if you listen to that, they'll never say a peep about another straight year. Maybe at the end of the year they're on show, but during the year they'll never say a peep about another great week in the market. They don't mention the market at all. But sure as heck,
downturn.
As soon as there's a downturn, it's on that show every morning. Oh, again, the market took its worst downturn in 9 years. 10 years.
It feeds on
They
itself.
love negative news, is my point.
Well, fear is what gets people to watch. They're media companies.
That's why no one's
response.
reminding people that we've been here before.
Here's the other thing, too. As I've been looking at this, up markets tend to happen much more gradually. The recoveries, they tend to go, you don't see a 10, 20% jump generally within a couple of months. But downturns, when they happen, when they become bear markets, more often than not, I believe, happen suddenly, which is like an earthquake.
Your point is you see a 1,000-point Dow drop.
You see it,
and we've seen one, not pretty recently. You'll see a 1,000-point Dow drop in one day, but it's rare that you'll come back in a day or two or a month or two and say
it'll take 3 or 4 days.
It'll take 3 or 4 days. It'll go up 300 a day to make up for that 1,000.
It's much more noticeable, but people don't pay attention to that kind of thing. So I guess the point is that. How many times have we said this? We've said bear markets happen. Things happen. You have no control over those things that happen, okay? You can control certain aspects of it. You can be prepared. This goes back to that buckets discussion that you guys have been talking about. And again, for the third time, this is why you do buckets. This is why we set up our portfolios so that, what are you more concerned about? Growth? Yeah, you want growth, but isn't it better to be able to pay your bills? Especially as you're retired, right?
Yeah, no, that's exactly it. But so my whole point today is in all these scenarios we've been here before. It's a reminder of what money is where for what purpose, and ignore the sensationalization, I guess.
Right, and if you are looking at the market to fund your needs over the next couple of months, you are in the wrong place to begin with. That's the whole idea. Money that you need to spend short term being multiple years, should not be in the market.
I got to say this, Rick, on a total separate note. I love running into the people that, months ago were telling me that the greatest investment in the world at 60,000. And I say, hey,
how's that going?
I don't watch it. What's it at?
We don't recommend. This is why we don't talk about individual things like that. Like whatever. We just don't get into
the currency, the whole thing.
Yeah, general. They've all
stunk up the world.
Yeah. They have. Now, does that mean anything to anybody? You have to talk to your own financial advisor and discuss whether that kind of thing is suitable for you. So, this is why we don't talk about things like that. We want to make sure that you've got enough money to last potentially your lifetime. And if there's any left over for your heirs, that's even better. Great discussion. I really appreciate this. Terry, why haven't we had you? What was you've never been on our podcast.
It's because I'm very expensive. When they get the bill upstairs for this, you're going to realize why I'm not here that often.
They pay it upstairs. What do I care? I don't have to do that. We can't afford the limo every single time. Terry Keys.
I would have taken a ham sandwich and been happy, just so you know, John.
Well, you said you've been in this business for 30?
Over 30. That's all I say now.
Almost 40.
That's right. 1983
was my license.
Yeah.
Was license.
We're coming up on 40 years. People have talked to you in the past. Do you have any? Do you have like a specialty, or you just kind of go? You cover everything when you talk about. Some people are insurance. Some people are more.
Yeah. So over my career, I've done different things and specialties and jumped around the industry a little bit. But now the last 10 to 15 years, I love just working with clients on their entire portfolio, from their short-term money to their mid-term money to their stock market money to their alternative investments, and just it's all about strategy. We just talk strategy all the time.
Well, that's what I love, and I'm talking to you, Terry Keys. I talk to Professor Plum every single week, and some of the other advisors at Lucia Capital Group. They're all on the same page. You guys are all cut kind of from the same cloth, and I mean that in a good sense. Mm-hmm. You have a strategy. You know what the strategy is, and you follow the strategy. I can ask you a question, Terry Keys, and get pretty much the same answer
when it comes
that I
to
would
strategy, it's going to be the same answer.
from Professor Plum. There's really no other way to do it. And I think that's particularly helpful to people who say, I want a bucket strategy, I want to do it right. There aren't really too many different ways to do it. All right? Everybody's situation is different, but based on somebody's situation, you both will agree, oh, here's a situation, I would do this. Terry, you would do the same thing as Professor Plum. And I think this is why I have you on the show. So love to have you back. If you ever have time. I don't know how I've had you on for 30 minutes, and I think that's about all the time that I have with you because I know you got to get back to work or whatever you were doing. But thank you very much. I appreciate it, Terry Keys.
Great. Good time, guys.
Chartered Financial Consultant. I have to keep saying it's ChFC, right?
That's it.
Chartered Financial Consultant Terry Keys. Professor Plum, thank you.
You're welcome.
We're going to do this again. Maybe in another episode or two, we'll have a couple of more advisors. I'd love to have this advisor discussion, talk about different aspects, things that you've talked to people about, always important. Professor Plum, Certified Financial Planner Professional, CFP Professional, as we call him. For these two guys, I'm your podcast host, not the advisor, but the host, Johnny Dean. Thanks so much for listening. It is Managing Your Financial Future. We'll talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. S&P 500 Index is an unmanaged index that includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. The Dow Jones Industrial Average Index measures the performance of stocks of 30 U.S. blue-chip companies covering all industries with the exception of transportation and utilities. It is price-weighted. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License Number 0518721. Rick Plum and Terry Keys are registered representatives with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.